All right, let's just jump right into this. Welcome to today's Explainer, where we are unpacking a fascinating and honestly kind of terrifying financial phenomenon. We're looking at something that sits right in our driveways, something we literally use every single day, and yet it is quietly draining American wallets. We're talking about car payments, and more specifically, why seemingly manageable car purchases are acting as a massive anchor on personal wealth. If you've ever felt like you're making good money but just can't seem to get ahead, well, the missing piece of the puzzle might just be sitting in your driveway. Now, there is a crucial financial truth we need to establish right out of the gate. You can afford the monthly payment, but that doesn't mean you can afford the car. I really want you to let that sink in for a second, because this simple truth is the absolute core of our story today. It completely flips how most of us are taught to think about large purchases. We're so conditioned to think in terms of monthly cash flow. If a payment fits into this month's paycheck, we just assume we can afford it. But as we're going to see, that line of thinking is exactly what keeps so many people broke. To make this concrete, let's ground it in a story. Meet our young American worker. They're doing everything right, you know? They have a solid job, they're earning a decent salary, and they feel like they've finally paid their dues, gotten a little momentum, and honestly deserve to upgrade their ride. And let's be super clear here. There is absolutely zero shame in wanting a nice, reliable car. We all want to feel safe and proud of what we drive. But our protagonist is about to make a major financial decision, and they're stepping onto a car lot armed only with their monthly budget in mind. And boom, here is the shiny object of their desire. The sticker price? $45,000. Now, for an average young earner, a $45,000 lump sum is completely out of the question. I mean, if they had to write a check for that today, they'd walk right off the lot. The dealership knows this. They know a massive number scares people away, so they don't sell the $45,000 price tag. They sell a completely different number instead. Which brings us to a pretty crucial question. Why do buyers only focus on the monthly payment? Well, it's because the entire sales system is brilliantly designed to mask the actual financial burden of the vehicle. When our buyer sits down at the desk, the salesperson doesn't ask, hey, how are you going to pay $45,000? They ask, what kind of monthly payment are you looking for? It feels helpful, right? It feels like they're working with your budget. But in reality, shifting the focus to the monthly figure is a mathematical magic trick that completely hides the true cost of the transaction. To see exactly how that magic trick works, let's dive into the total cost of a standard 48-month loan compared to a stretched 84-month loan. To get our young workers' monthly payment down to a number they think they can swing, the dealership simply stretches out the timeline. They offer a 6 or even a 7-year loan. Suddenly, that $45,000 car looks incredibly affordable on a monthly basis. But by dragging the loan out to 84 months, the total amount of interest paid over the life of the loan absolutely explodes. If you finance $45,000 at an average 7% interest rate for 84 months, you aren't paying $45,000 anymore. You're paying over $57,000. That is an extra $12,000 just for the privilege of borrowing money. You're paying a massive premium for the illusion of affordability. But here's the thing. The loan itself, even with all that extra interest, is literally just the tip of the iceberg. The real danger of a car purchase lies beneath the surface, in costs that most buyers drastically underestimate when they're dazzled by that new car smell. We like to call this the hidden iceberg. Think of your true monthly cost like a giant pie, right? The loan payment is just one single slice. To keep that car on the road legally and safely, you have to factor in the whole shebang. You've got comprehensive insurance, which is vastly more expensive on a brand new vehicle, often adding $150 to $200 a month. You have fuel, you have routine maintenance, oil changes, and eventually tires, which easily average another $100 a month. And you have annual registration fees and taxes, which are almost always tied to the value of the vehicle. When you add all these slices together, your seemingly manageable $700 car payment is actually costing you over $1,100 a month in real money. But wait, it actually gets worse. Actually, scratch that. It gets a lot worse. As if the exploding interest and the hidden monthly costs weren't enough, we have to talk about what is truly the ultimate wealth destroyer in this scenario. This is the most silent but devastating cost of buying a brand new vehicle, and it's the one thing that actively works against your financial future every single day it sits in your driveway. That silent killer is depreciation, the rapid loss of value an asset experiences over time. And cars, they are notoriously terrible assets. In fact, the second our protagonist signs the papers and drives that beautiful new $45,000 car off the dealership lot, a huge chunk of its value simply vanishes into thin air. A brand new car can easily lose 20% or more of its value in the very first year. That's $9,000 wiped out in 12 months. You're paying high interest on a loan for an asset that is simultaneously bleeding value day by day. It's kind of like trying to fill a bucket that has a massive hole in the bottom. So, what does this all mean? Well, when so much of your monthly income is tied up in a depreciating asset and all its associated hidden costs, you basically become financially paralyzed. It delays your ability to invest for the future, it stalls you from building an emergency savings net, and it strictly limits your lifestyle flexibility. You're locked into needing a certain income just to keep your driveway occupied. The car isn't just taking your money today, it is completely stealing the money you could have had tomorrow. So, let's explore what happens if our protagonist makes a different choice. Let's look at the opportunity cost. Opportunity cost is basically asking, hey, if I don't put my money here, what incredible things could it be doing for me over there? We're going to look at a tale of two paths to see how one different decision today completely alters our workers' financial destiny. Let's compare these two paths side by side. On one hand, we have the $45,000 new car. On the other hand, a perfectly reliable, gently used $15,000 car. When you factor in the lower loan balance, the dramatically lower insurance premiums, and the lower taxes of the used car, the true monthly cost drops significantly. And suddenly, a magical third category appears: cash left over to invest. By choosing the cheaper used car, our protagonist frees up easily $400 to $500 every single month. That is cash flow that was previously being burned on depreciation and interest and is now sitting right in their pocket. And this brilliantly illustrates what happens over 7 years. If our worker takes that monthly difference, let's say $500, and invests it consistently over the next 7 years, instead of dumping it into a car payment, the results are staggering. Thanks to the power of compound interest, that money doesn't just sit there, it grows. Assuming a historical average stock market return of about 7 to 8% annually, investing that $500 a month turns into over $50,000 in just 7 years. Over the exact same period they would have been paying off a depreciating car, a car that's now worth a fraction of its original price, they have instead accumulated a massive pile of wealth. They changed their entire financial trajectory simply by avoiding a bad car loan. So what is the takeaway here? We all still need to get to work, run errands, and live our lives, right? You don't have to walk everywhere to be financially responsible. Let's look at some highly practical, actionable takeaways you can apply to your own life without sacrificing your mobility. Here are 3 simple rules for buying a car. Let's walk through these really quickly. Step 1, never ever buy based on the monthly payment alone. Always negotiate based on the total out-the-door price of the vehicle, so a dealership cannot play that timeline trick on you. Step 2, avoid loans longer than 48 to 60 months. Keeping the term shorter ensures you don't end up owing more than the car is worth as it depreciates. If you have to stretch the loan to 7 or 8 years just to afford the payment, mathematically, you cannot afford that car. Step 3, before you sign anything, calculate the true cost. Factor in insurance, fuel, and upkeep first. If you follow these 3 rules, you can buy a vehicle without accidentally self-sabotaging your long-term finances. Which leads us to this final, pretty incredible thought. The most expensive car isn't always the one with the highest price tag. Sometimes it's the one that keeps you from building wealth. It's a powerful shift in perspective, isn't it? It challenges us to look past the shiny paint and the new car smell and recognize that our daily transportation choices are actually the foundation of our long-term financial freedom. Just before we wrap up today, I want to emphasize that the information provided in this explainer is strictly for educational and entertainment purposes. It is absolutely not financial advice. But I really hope this breakdown has empowered you to look at your next big purchase through a totally different lens. Understanding the math behind the machine is how you take control of your wallet. Thank you so much for joining me today, and I'll catch you next time.